Hello, friends, and welcome back to Market Shares. I'm your host, Tony Blodgett, and today I have with me a good friend of the channel and someone who I have a lot of respect for, and you're going to really enjoy this conversation. I have Dan Habib with MBS Highway, also with CryptoCharged, and I've had Dan on a couple times, and we always have really thorough updates on what's going on with the mortgage market, real estate, etc., and we're going to touch on some of that today, but I wanted to focus more on Dan's expertise around cryptocurrency, and there's a lot going on in the world of crypto. So Dan Habib, welcome to Market Shares. Thanks again for giving us some of your time.
Yeah, Tony, great to be with you. Always a pleasure. I think you do some incredible things on this channel, so it's an honor for you to have me again.
Yeah, well, thank you. Well, it's hard for me not to talk to you about, what's going on in the mortgage market and mortgage-backed securities and all that, because I watch your updates every day that you and your dad, Barry, do, and your whole team. It's phenomenal. I don't know that any mortgage professional should really be trying to run their business without checking in with MBS Highway every morning to not just hear what's going on, but get the talking points. What you guys have always done, what I've really appreciated about Barry for my whole career, is taking the complex and putting it into words that we can then regurgitate to our clients, our referral partners, and it makes sense, and that's always been super helpful. And so I'm sure we'll talk on a little bit of that today, but we started dabbling a little bit in our last conversation about crypto. And at the time, Bitcoin was really at probably close to its peak. 108, 109 was kind of the high water mark. And it was, a lot of speculation out there that it was going to keep going, that it was going to hit 150 before we saw a pullback. And then, I don't know if it was the tariffs. Maybe you can talk to us about kind of what pivoted that move, because I think it went all the way back down to about 83 here just over the last few weeks. And now it's starting to kind of resurge again. So maybe just on a big picture, especially around Bitcoin, maybe you can give us, what's caused this roller coaster. I know it goes in cycles typically, and I'm just going to disclaimer for the audience, like Bitcoin is not my area of expertise whatsoever. That's why I wanted Dan on here. I can shuck and jive on the MBS stuff, pretty good, but this stuff, I might be a little ignorant, so bear with me as we go through it. I dabble in crypto. I have some Bitcoin and some Ethereum, and I'm not even going to talk about the other one that I have. It's embarrassing, but we can maybe talk about it later. But Dan's the expert. So yeah, maybe on a high level, what's going on with Bitcoin? And maybe if you through that can touch on the institutions that have been buying up Bitcoin. Some of these, big companies, like Michael Saylor's company and then others that are kind of creating their Bitcoin reserve. I'm sure that all plays into it, Dan.
Yeah, no, thanks for the nice comments. And there certainly is a lot going on, a lot of volatility, not just in crypto, but also the stock and bond markets, and really all the markets overall. Very interesting time where you saw stocks moving lower, yields moving higher, the dollar moving lower, and you saw gold setting new all-time highs, like above $3,400 an ounce. So was a pretty wild time in the markets. Obviously, a lot of influence with what's happening with the tariffs. Are they on, off, and whatnot? But we did see crypto, Bitcoin specifically, reach a level of around 109,000 per coin, which was pretty significantly high level, something that I was calling for above 100,000, but actually have some targets based on where we are in the cycle, which we'll go over, higher than that. However, Bitcoin has showed a pretty high correlation, at least thus far, to other risk-on assets, which when I say that, I mean stocks. So there's a very high correlation. Lately, we've been seeing a little bit of an uncorrelation. I think many crypto investors wish that there was more of a decorrelation there. So in your portfolio, you could have some alpha from cryptocurrency as opposed to it just being like a riskier stock investment. But thus far, it has certainly seemed to follow the stock market, but oftentimes at a either faster pace to the upside or downside. So Bitcoin did, as you mentioned, hit that level of around 109,000, but you saw stocks sell off, and a lot of this had to do with tariffs and such. And Bitcoin actually came down as low as like just above 74,000,
oh, wow.
which I thought was a great buying opportunity. I was telling people that because we'll look at some charts in a little bit too, but it did, I think, need to eventually come down and test the breakout around that area. That area had not been back tested yet. So I actually think it was kind of a healthy thing that happened. But here we are now, it's above 95,000 a coin. So it moves quick. And yeah, I think if we look in the span of like days and months, it's very, very difficult to say where it's going to be. But if you look longer term and you look farther out, boy, I think it's the most exciting investment out there that exists. And looking historically over the last 10 years, it's been by far, and I mean by far, the best performing asset class. And I think the same will hold true over the next 10 years. So there's a lot of volatility in between. I don't recommend trying to play the market. It's hard enough. I mean, it's nearly impossible to time the stock market. And that's why most index funds outperform any kind of money managers or hedge funds over time in almost every circumstance because timing the market's difficult. You're better off, buying and holding and dollar cost averaging, and when prices come down, maybe loading up a little bit as opposed to trying to time the market. But it's even harder with crypto because crypto is even more volatile and it's a currency, which means that the stock market will close in the afternoon. Cryptocurrencies trade like other currencies 24/7. So you can have a lot of volatility when the Asian trading session is going on, which is nighttime for us when we're essentially sleeping. So let's talk first a little bit, Tony, on what cryptocurrency is. And remember, there's now tens of thousands of different cryptocurrencies. But by far, the biggest, most well-known is Bitcoin. And you've probably heard people talk about Bitcoin and say that it's like digital gold, maybe that it's a good hedge on inflation. And the reason why they say this is because Bitcoin is scarce. I think one of my favorite properties about Bitcoin is that it's the most finite asset that I think we've ever seen because there is a hard fixed number of 21 million Bitcoin that can ever exist. And we have like just under 20 million that have already been created. So not much more left to be created. And when you have scarcity, especially over time, and you have more adoption and demand, what happens, right? I know a lot of your audience is housing related, right? So, imagine if you had a fixed number of homes, right? And, you couldn't create any more. You still have things going on in the background. Eventually, what is that going to do to the price, right? You're going to have demand just groundswell and overwhelm the supply. And a lot of that's the reason why gold has value. Gold is a scarce, finite natural resource that's very expensive to mine. And it's part of the reason why it's so good at holding its value and why it's a good hedge against inflation. So I think, one of the things I want to try to do here is take it step by step and take this complex topic of cryptocurrency and Bitcoin initially here to talk about and try to make it easy to understand. But listen, it is complex. So, put your thinking cap on a little bit here and bear with me as I try to break down some of the, I think, reasons why it was created and really what it is. So when we look at the currency that we use every day, the dollar, it is called a fiat currency. And what that really means is that it's not backed by anything. Back in the day, it used to literally be like a receipt for gold that was held in reserves. And that obviously went away. And now, being fiat currency, it means that the only thing that's backing it is the full faith and credit of the U.S. government. And in order for a fiat money system to work, the dollar, you have to have a centralized finance system. And that means that the government and the central bank really control the money supply. One of the drawbacks of fiat currency is we can continue to digitally nowadays print money. And when you have more supply of money or you have the government giving 5.2 trillion in stimulus, what does that do? It devalues your dollar, inflation goes up, and you can buy less and less of goods and services with that dollar. So it loses value significantly over time. And, when we take a look at what the Federal Reserve, their goal is to only see 2% inflation each year. Now we're above that. And of course, we had period of time over the last few years where we were well above that. But that means that even in their like ideal situation, you're still losing your value at a rate of like 2% a year, or your purchasing power. And as I mentioned, there's not a limited supply. We can theoretically create as many dollars as we want. And when people hear cryptocurrencies, they hear digital currencies. I think it's important to note that most money is digital nowadays. If you look at like the whole scheme of transactions, a very small percentage now is actually done in cash, where you're in person with them exchanging that. Most of it's done on PayPal, Venmo, credit cards, debit cards. Almost, the vast majority is done digitally anyway, but it is predicated on the dollar value. And you need a centralized finance system not only to manage the supply of the money and the cost of the money. If you have heard about the Fed cutting and raising rates, they're literally changing the cost of money as they adjust the Fed funds rate. And as they make the Fed funds rate higher, well, borrowing money becomes more expensive and vice versa. But in the centralized finance system with the dollar, you need certain centralized institutions. So think about it like this. If you go to the store and you swipe your credit card or your debit card, what's actually happening? Well, you swipe it at the merchant. It then goes to a third-party processor, and it either, goes and checks the credit card company to make sure you still have limit available, or it checks your bank to see if you have the dollars that you say that you have. And then that obviously goes back to the merchant, and you are either approved or declined. But it doesn't work without the centralized finance system. It is completely reliant on that. And listen, there's some drawbacks to that too. You've heard of stories about people that you think your money's safe in your bank, but you don't necessarily bank yourself. You don't have complete control over that because you rely on them for everything, and they could freeze your account. Listen, there's been situations of things like that happening. But Bitcoin was created, I think a lot of people think it was created maybe as a replacement for the dollar. Let's be clear, I don't see that happening, but there's certainly a space for it. And I don't think that transactions with Bitcoin are, at least today, realistic, because there is a tax consequence that could be greater than even the item that you're purchasing. However, Bitcoin was, I think, created to create a form of decentralized currency. So what that means is that you and only you bank yourself. You can send transactions to anyone anytime you want. You don't need to wait for the bank to open, or for it to take several days for a wire, or maybe a week for an international wire. These things are happening pretty instantaneously, and it's peer-to-peer. You don't have the need for any centralized institution. You don't need a government. You don't need a Fed. You don't need to have middlemen that are helping to facilitate the flow of money and funds. And it really operates more like a cash transaction, that you're doing a transaction with an individual right in front of you. And you have complete control of your money. If you were to invest in cryptocurrencies and then take custody of that, you and only you have access to it. You don't have to go to the bank. You and only you can control it, and you can send it for different purchases or to people as payment anytime you want, and it's borderless. So how does it work? Well, let's go back to the bank example. The bank pretty much has a ledger for you. So I have a bank account at Wells Fargo. So Wells Fargo has a ledger. Now, it's not a transparent ledger. It's not like a public one where people can see. It's behind, obviously, a security wall. But it very much works like a ledger. I have my direct deposit from work coming in, right? And I have other forms of income coming in. And then I also have expenses going out, my mortgage payment, my other payments that I have. And they keep a running live ledger so you can see how much money is available. And when you make transactions and purchases, it can check against that to see if you have the money available. Well, Bitcoin, how does it work if there's no centralized institution, if there's no bank that's checking that? Well, they have what's called a blockchain, and it is literally a global transparent ledger. So think about the ledger that's kept at your bank, except this is a ledger that is really the blockchain, and it is kept by the millions and millions of participants that are plugged into the network. So Bitcoin really is like the strongest computer network in the world. You have millions and millions of computers with their processing power, and what they're actually doing is keeping the ledger secure and accurate, and it's using the computing power of all these computers plugged in the network to verify and check transactions. And you might say to yourself, well, why would they want to do that, right? I mean, why would you want to plug into the network and verify transactions? Well, it's because the reward is in the right place. Just like with gold, in order to get more of it, you have to mine it. With Bitcoin specifically, you also have miners, but they're not, taking like a pick and a shovel here and trying to extract gold from the earth, but they are using their computing power to verify transactions. And the byproduct of doing so is that you can get a reward in Bitcoin. So if you have enough computing power, essentially without getting too deep here, you have to solve something called a hash function, which means that your computer, as you plug into the network, it's using its processing power. It's trying to solve this math problem, essentially. And if you are the first to do so, you get rewarded in actual Bitcoin. And the cool thing about it is this, is that number one, there's no variability in the supply of Bitcoin that's coming into the marketplace. It's not like the Fed or the government can say, hey, we need to stimulate things. Let's go ahead and issue treasuries and introduce digitally more money into the equation here. It is on a set protocol. And the only way that new Bitcoin gets introduced into circulation is the byproduct of keeping the network secure. And the miners or the ledger keepers or the computer networks, the computers plugged into the Bitcoin network, them verifying the transactions, well, that's how you get new supply because the reward is in Bitcoin. And that's the only way that new supply comes into circulation. So, Tony, I know that some of that might be a little bit confusing. So I wanted to just kind of pause there. But Bitcoin, when it was first created, you had, and remember, there's 21 million that can ever exist. When it was first created, the reward was about 50, well, it was 50 Bitcoin per block. And then every 4 years, that number gets cut in half. And that's why you may have heard of something called the halving event. And the way it works is the difficulty of the math equation adjusts so that approximately every 10 minutes you're getting a new block that is mined and then a new reward that is issued. So I actually think I have a pretty good slide to kind of help you to visualize this, because this is an important concept within Bitcoin specifically. So Bitcoin scarcity is key. When this was created, you had a reward of 50 Bitcoin, and based on every 10 minutes, 144 blocks, you were having 7,200 Bitcoin come into circulation as new supply every single day on average. But then 4 years later, that reward got cut in half to 25. And that means that 3,600 Bitcoin were created each day, and then cut in half in 2016, 2020. Most recently, April of last year, that reward was cut, and you have now only 450 Bitcoin that are coming into circulation per day. So it's almost the opposite of inflation. You have less and less and less supply coming to market every day until you eventually get to the terminal number of 21 million Bitcoin.
I do have a couple questions. That was that I've never heard it explained that way. So thank you for that. I mean, I think that some of it I understood for sure, but that was a very concise way of laying it out. It does bring me to the question, though, if the incentive for me to have my, this very powerful computer connected to the network to validate these transactions, if my reward for that is this Bitcoin, I have to imagine there's some point, sounds like potentially not too far into the future, where there isn't a reward for that anymore because it's all been issued. If we're already at 20 million and there's only 21, like what happens at that point? And then what's the incentive to have these computers continue to validate these transactions?
Great question. So first of all, because of the way that the reward is getting cut in half every 4 years, the estimated time when you will have no more mining left essentially is not till the year of 21 like 50 roughly, right?
Okay.
So it goes a long time, but the reward does exponentially get cut lower and lower, but you have to remember the price is likely because of the scarcity going to continue to go up, 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 right? So the 50 Bitcoin reward back in like 2010 is very different than a fraction of a Bitcoin when it's over $1 million a coin or more, right? But even so, you're right. That's a good concern to have, but there's fees that are tied to all of these transactions that they get as well. So, a block has like a bunch of transactions in it, and there's fees tied to it that would still incent you to do so. So there's I don't see a world where, especially based on the players involved, that you get to a point in 2150 where there's no more mining, and then it still doesn't make, or no more coins to be created, and it doesn't make sense to mine or do so.
Got it. But even that event's not for another 125 years, it sounds like.
Correct.
So
Correct. Yeah.
we probably won't be around to experience that, Dan, unless
Well,
something,
I
crazy
mean,
happens.
I, I won't plan on it.
Okay, so that's interesting so it sounds like the 20 million to get from 20 million to 21 million because of the halving, it's really slowing down how fast that's going to happen. So although it sounds like we're right there, ready to have all of them out into the world, it's going to take another 125 years. One thing that you mentioned that I have a question about is the idea of taking custody of the money.
Mm-hmm.
And you mentioned this on our last conversation just briefly, but as a kind of amateur crypto person, I have a Coinbase account. I transfer money from my checking account and I buy my crypto. It sits there in Coinbase. And you were saying, and there's a lot of fees. You're right. If I transfer that, if I want to cash it back out, I got a tax event, I got fees. If I want to buy more, I got significant fees. And it's not in my possession really at that point in time. What you're talking about is there's ways of truly taking that out of even like a Coinbase and having it in some sort of, I've heard of these wallets, like the cold wallets. I don't even know the terms.
Hardware wallets. Yeah. So
yeah, can you speak to that?
Yeah. So one thing that's different about cryptocurrency versus, let's say, like buying like a stock is that you can take self-custody of it, where you can take it off of the exchange. Now, you have to be careful here, right? So there's many different ways that you can get exposure to cryptocurrency now. It used to really just be that you would have to go to a crypto exchange and purchase it there. And before Coinbase, a lot of this was really just available on overseas exchanges and such. And I'm sure many of you have heard of some of the nightmares that occurred with bad actors out there, like FTX, for instance, where millions of people lost their shirts and lost all of their investments there. And that's because if you leave your coins on an exchange, you have third-party counter risk that you're susceptible to. But a lot of people, when they heard about this stuff, they said, see, I told you crypto's a scam. And I laughed at that because I want to give you an example that I think everybody can understand. Let's say I was buying Apple, and I was buying Apple on one of the online exchanges. Let's say I was using something like Fidelity or TD Ameritrade, right? And I put my money there from my checking account and I purchased shares of Apple. Now, if all of a sudden TD Ameritrade apparently was a bad actor, they were misappropriating customer funds, they were being risky with it, and I lost all my money there, nobody would go and point the finger at Apple and say, see, Apple's a scam. It's the exchange, right? It's the same thing here. And don't get me wrong. There's plenty of cryptos out there that are scams because there's a lot of these pump and dump schemes. There's tens and tens of thousands of coins. I'd say probably 25% at least are actually scams or bullshit coins. They call them shit coins. That's the proper terminology. But there's several that are good that actually have what's called utility, that are serving a purpose, solving a problem, making things cheaper, more efficient, crossing borders. We can get into some of that stuff. But today, there's a lot more options on how you can buy it. So one, you can buy it through, Venmo, PayPal, these different things, but you're not actually getting the ability. You're getting exposure, but you're not getting the ability to take the coins from that and take self-custody. You just have ownership of it, but that's with them. Now, there's Coinbase, which is a US publicly traded company that you can go to. It's an exchange. You can take your dollars and fund it, and then you can go ahead and purchase cryptocurrencies. That's obviously the safest method. That's where I buy most of my coins. They don't have potentially every coin that you're looking to buy on that exchange. So you might have to go elsewhere to buy some other smaller, lesser known ones, let's say, but they have the majority. So you can buy coins there. Another option today is that you can get exposure to crypto via ETFs, spot ETFs, which is essentially, you guys have all probably bought exchange traded funds. You might not know it, right? But that is essentially like buying a stock. And one of the reasons why Bitcoin's price really went exponential to 109,000 is because it was much easier to buy and it was much more accessible. The majority of the wealth in this country and in the world is the top 10% that the majority own stocks. A lot of them could be older. A lot of them might not be, comfortable going to a crypto exchange and dealing with that. But they're very familiar with telling their financial advisor, hey, you know what? Allocate X% of my portfolio to crypto now that I can. So you have spot ETFs, which is essentially being able to buy Bitcoin, Ethereum, and there's several others that are not approved yet, but that should be soon, like XRP, Solana, and there's going to just be more coming, where you can get exposure to crypto. You don't have to worry about self-custody. You're buying it essentially just like a stock. And, this has been kind of a slow adoption for a long time. I remember there was a lot of big financial firms that couldn't even talk about cryptocurrencies, but there was enough of a groundswell of demand from people wanting this and to get access to it that they ended up having to succumb to creating these spot ETFs. Now, the self-custody question that you're asking is, why would you even want to do that? Is it necessary? It's certainly not necessary. For some people that don't want to kind of get a little bit more involved in this, I'd probably recommend just buy IBIT, which is the BlackRock ETF where you can buy Bitcoin. Very easy way to get exposure. But if you want to take self-custody, I go to Coinbase, I purchase Bitcoin, and then instead of leaving it on the exchange where you do have third-party counter risk, do I think that's a pretty safe spot? Sure. But there's other advantages if you take self-custody. So I can take the coins, and instead of keeping them housed on the exchange, I can essentially put them into the blockchain, but then I get access to it with something called a hardware wallet. It's like a little device, and you have a password. You also have a 24-word recovery phrase. And I can go anywhere in the world with this device and sign transactions and send money. If I lose a device, so long as I have that 24-word phrase, I can recover my cryptocurrency anywhere, so long as I have internet access. But you have to be careful. There's certainly a lot of nightmare stories where people lose a device, they forget their password, they lose the 24-word passphrase, and then once you lose that, there is zero recourse. So you have to make sure you're being careful and doing things correctly. But once I have self-custody, I use something called a ledger. So it's one of the hardware wallets. And I used to have the Ledger Nano X. Now I have the new one that came out called the Ledger Stacks, which it's like cool. It's like a touchscreen, very easier, much easier to do transactions with and such. But then you also get like an app with it. And you can see all your crypto that you have in your custody, essentially, and not on the exchange. But then since you have custody of the coins, you can stake them for certain coins, depending on their consensus mechanism. So Ethereum, for instance, you can take the coins that are in your custody and pledge them into a pool where some of them have like certain lockup periods and stuff. But if you plan on holding it, it's a way for you to earn additional yield. That yield can change, but maybe now it's around 4% a year. But other coins, they give you 15% or so. So you can earn additional yield just by staking them, which basically means you're just clicking a button on this app and it is holding it in a pool here. And then when you want to take it back from there, you can, but some may have 30, 60, 90-day lockups or more, depends on which one you're doing. But you also could borrow against it if you have self-custody. There's plenty of companies out there now in the crypto realm, like let's say like in Aave or something, where you can lend against your crypto. So there's a lot of other options and ways that you can utilize the crypto if you take self-custody. I'm a big believer in it. There's a lot of people out there that are really crypto diehards that, the saying is like, not your keys, not your crypto, meaning like if you don't take self-custody, it's not really yours, right? But for the vast majority of people out there, if you want exposure, and you want to dabble a little bit, I think it's perfectly fine to buy one of the spot ETFs to get access, and I would recommend iBit.
Okay. And it sounds like the ETFs aren't even going to have the same fees you would get from Coinbase if you were just purchasing, the coins directly on Coinbase, because there is a pretty decent fee for, a transaction fee for those.
Depends. It depends, right? So it depends how much you're buying. It depends on the type of order. I mean, it can be pretty minimal, but if you're buying size, the fees can be bigger. Also, it depends on the exchange you're on, the liquidity, and also like, not to get too technical on types of trades, but you have market orders, which people are probably familiar with. That's where you say, hey, I want to buy 10 Bitcoin, but I want to buy it right now. So what you're actually doing is taking liquidity out of the market, and you are paying for immediate execution at the best possible price. But if you have a market that's maybe not that liquid, you can have what's called slippage, because what you're actually doing is taking from the order book people that are saying, I'm willing to sell the Bitcoin at whatever price. And if you want to buy 10 Bitcoin, the price on the screen might be what's available, but maybe only one Bitcoin is there. But then in order to fill your order of 10, you actually get executed on a much higher average price. Now, you could also do a limit order. Limit order is different. Limit order is where, hey, I can only, and the point I wanted to make on that is the fees are higher on market orders because you're taking liquidity. Limit orders, you're actually like adding liquidity to the market. And with a limit order, you're saying, I only want to buy it at this price, and that's it. And you won't be executed above that. And because it's not a market order, the fees are less. But I think you'll find like most people aren't out there buying 10 Bitcoins, right? Which now, would be just short of like $1 million, right? So if you're buying fractions of a Bitcoin, which that's another key point, Bitcoin, you don't have to buy one. A lot of people have that like misconception. You can buy $10 worth. You can buy $100 worth. And, Bitcoins can be split into a millionth of a Bitcoin. So it can get very, very fractional. But if you're doing, smaller amounts, the fees are pretty minimal, actually. But if you can even reduce it further by doing limit orders.
That makes sense. That makes sense. Let's talk a little bit about what changed when the Trump administration came in, because there was a lot of talk about how that would impact. And I don't know if it's so much Trump himself. I don't know if it's the cabinet that he chose. I don't know if it's the new Treasury Secretary. Like, what is it about, the new administration that got people excited about what would shift around crypto?
Yeah, well, that was another reason why we saw cryptocurrencies really take off and Bitcoin soar to 109,000, because of a friendlier regulatory environment. And Trump is pro-crypto, but really his whole administration, Scott Bessent, the SEC chair, it used to be a guy by the name of Gary Gensler. And he was pretty much anti-crypto. He would block anything possible, make it as difficult as possible to get things through. That has all changed. You have a much friendlier pro-crypto regulatory body and administration. The new SEC chair, Paul Atkins, is pro-crypto. So that just makes it a lot easier overall. And this administration really sees the value and importance from a global strategic sense to have crypto. And as such, they announced that they're creating what's called a strategic crypto reserve. And initially, some people were very, very excited about this, because imagine you have this finite asset and you have our government, our country, and other countries following suit, buying this thing and stockpiling it. And obviously that's going to be pretty locked up supply, much like with gold, right? How, nations are buying and holding gold. So Trump and the administration see the value in that. They said they're going to create a strategic crypto reserve. Initially, they said we're going to have a Bitcoin reserve. Then they said we're going to do US-based cryptos like XRP and Solana and Cardano. And then he said, of course, we're going to include Bitcoin and Ethereum. So there was like kind of bouncing around as far as what was actually going to happen. But what's happened thus far is they said for sure, we have from nefarious activities and such, we have 200,000 Bitcoin that we've confiscated. They actually had much more than that and they sold it over time. But they said instead of selling this, we are going to take the 200,000 and create the strategic Bitcoin reserve with it. So now that 200,000 Bitcoin, which is a sizable amount, is being held by the government. And there's stories all over the place of other countries now that, you have El Salvador that has literally made it their legal tender, but other countries doing similar things, calling the U.S. about ideas on how to create a strategic reserve. And while I think that's great, boy, would I love to see the U.S. making outright purchases. And what they did in the kind of writings of this was they certainly left the door open for that to happen. But the key is that they wanted to be a net neutral impact to the U.S. taxpayer. So if they trim spending somewhere else, they can use that money to buy crypto. So that hasn't happened yet, but I think it will. But just with the easier regulation and more regulatory clarity and the U.S. getting behind it, you can already see what's happening, which is now other companies are much more easily able to adopt it. For the longest time, without regulatory clarity, because of the bylaws of publicly traded companies and stuff, they literally couldn't purchase it. But you had Tesla that adopted it as a balance sheet asset, right? I mean, these companies, they hold a large amount, most of them hold a large amount of cash on their balance sheet. But instead of holding cash, why not put a percentage of that into something like Bitcoin? And MicroStrategy, another way you can get exposure to Bitcoin in a leverage sense, they've literally turned their whole company into it. Michael Saylor, boy, I think he's going to go down as one of the most brilliant guys. I mean, he took a big risk and he was believing so much in Bitcoin that his whole company now is almost just like a proxy of creatively raising money, either through stock or through debt. Actually, is the way he's been raising a lot of it, and then buying Bitcoin. And boy, they own a tremendous amount of Bitcoin. I think more than 5% of the overall market, and he has been proven to be pretty darn smart. Everybody was saying, he's out of his mind. And then Bitcoin goes, even at 95,000, he's up billions and billions of dollars on that investment. But he sees it, this is kind of just the beginning. But you see other companies that are starting to kind of mimic some of the things that MicroStrategy has done. Metaplanet's one, and there's a list of them. And when we talk about where Bitcoin's price is going to go, there's some crazy, at least in some people's minds, some crazy targets. Even like ARK, which is Cathie Wood, in their base case, they think Bitcoin by the year 2033, 8 years, is going to be over $1 million. And people look at that and they're like, how the hell is that going to happen? But the way that they came up with their forecast, and they really broke it down, is by a certain amount of nations adopting it, a certain amount of publicly traded companies putting it on the balance sheet, and we're already starting to see those things happen. And I think the fact that now you have easier accessibility through spot ETFs, which you buy the ETF and what's owned in the ETF is exclusively pretty much Bitcoin, right? So, they're eating up a large supply of the Bitcoin out there, and it's finite. So I certainly am a big believer. I would never tell somebody with certainty where Bitcoin's going to be over the next few months or days or even, year. But what I can tell you is that if you're looking to buy something and hold it for a period of time of greater than 4 years, but let's just say even 10 years here, I don't see any way in my mind that it's not at least a few $100,000 per coin, if not a lot more. And it has to do with the scarcity and the adoption story there. And remember, we're only going to have supply every 4 years coming to market get cut in half. You have demand that is continuously growing. You have nations getting involved. And right now, we're actually at an interesting point because there's something that happens every 4 years when you have this halving event. If you were to think about it, and let's bring it back to housing, if every 4 years builders said we're going to build half the amount of homes that we did 4 years ago, demand is continually getting tighter. And when that actual supply shock occurred, what would happen? You'd probably see home prices rise significantly. Well, that's exactly what happens with Bitcoin. And this is a chart that I wanted to share with you of the previous halvings, right? So the first halving occurred in 2012. The supply of Bitcoin, or the reward, got cut from 50 to 25. And the amount of Bitcoin coming to market every day went from 7,200 to 3,600. So the halving occurred here. Look what happened to the price of Bitcoin. It shot up. It went up 9,715%. Now, one thing you'll also see that's a common thread is while Bitcoin has these parabolic periods, it always has a pretty severe bear market that follows, where it is not uncommon to see 70, 80, 85, even 90% declines. But then it usually rallies into the next halving. And then from the time of that next halving in 2016 to the peak, it went up 2,862%. And then you had a bear market, and then you had the next halving, and it went up 720% to this peak. And then you had in 2024, April of last year, you had it enter around 60,000. And I think you could also see another pattern. So after the halving, you typically have a huge run up and then a bear market, halving, huge run up, bear market. The first return was 9,715. There's diminishing returns that are occurring here as the asset matures, as it grows in value, law of large numbers a bit here. But you then notice the return in this next halving was about roughly 30% of the previous one. And then 720 is roughly 30% of the previous one. Well, if we just stuck with that pattern, you would expect during this halving here, this next cycle that we're in, to see about a 216% return, which would bring Bitcoin to a price of like 188,000 per coin. Now, I don't think it's unreasonable to say that Bitcoin, and my target actually for Bitcoin was that, over the next year or so, that it would reach somewhere in the 130 to 150,000 range. It already did touch 109. It's now at 95. It's not abnormal to see 30% pullbacks during bull markets. That's actually more the norm than the exception. So if it is an investment that you are interested in, you better strap your seatbelt on and be prepared for volatility. For some people, they don't have the stomach for it, and it's not for them. But you certainly, if you bought and held this thing and didn't try to get too cute, I mean, there's no other investment that's yielded you greater returns. And the one caveat I would say with where Bitcoin's going is that we haven't necessarily seen a market like this through Bitcoin's existence. Yes, you had like the COVID recession, you've had some bear markets, but you've never had like a bear market paired with a recession. And because of the close ties of Bitcoin to stocks, what's going to happen if we do see a bear market and a recession, which I'm seeing a lot of recessionary signs out there. Is Bitcoin going to be uncorrelated, or now, especially because of the participants, is it going to fall with stocks if that happens? And it would be the first time that we didn't see, a really, really parabolic run up like we have every other halving based on this point in the cycle. So it's tough to say, to be quite honest with you. I mean, I can tell you confidently that, if you're not looking to make a quick buck over the next year or two, if you buy it even at these levels, I think it's going to be much, much higher when we look out several years. But I am a big believer, because it's such a volatile market, in not necessarily trying to time it, but dollar cost averaging. And what that means is you buy a little bit on a regular basis. So personally, I'm buying on the 15th and 30th of every month. And the reason why I do that is the reason they call it dollar cost averaging is because you're going to sometimes buy when prices are higher, lower, and over time it's going to dollar cost average your cost basis essentially lower. And it's consistent. It takes emotion out. But then if you do see, for instance, Bitcoin went from 109 down to 74, when I see that happen and I have the belief of where it's going to be down the road, sure, I'll load up a little bit more there and reduce maybe my cost basis if it's not already beneath that, or just buy more where I think it's attractive. But I would recommend not trying to time the bottom or the top of the market. I would recommend just buying on a consistent basis, and you will average your cost.
Got it. And Dan, so first of all, that chart was brilliant. I have not seen the halving and, kind of the fairly predictable cycle that then happens after that. I wonder, have you looked at what the timing has been from the halving to
The
the
peak. Yeah.
peak? And where are we in that cycle on after this halving?
Yeah. So based on history, and sometimes it's a little longer, a little shorter, but based on history, um, I would expect it to hit like that target somewhere in the August to the end of the year period of time. So,
Mm,
you know, could things be different this time? Maybe. But at least historically, from the last several halvings that we have seen, and there's not a huge history there, right? Uh,
right.
but but based on what we have, you would expect it from like August to maybe the end of the year in that time frame.
Got it. Well, and yeah, I mean, you're right. I mean, depending on what the stock, it is so closely correlated with the stock market that if we see the recession, we see a extended bear market, it might be tugging down on that, right? Keeping it from hitting those same sort of levels that we've seen in the past.
And interestingly, lately, we've been seeing the dollar move lower.
Right.
And when the dollar moves lower, that actually helps the price of Bitcoin to rise because remember, it's a currency. So currencies trade in pairs. So Bitcoin in dollar terms, if the value of the dollar is going down, is higher, right?
Mm,
So as a dollar moves lower, it takes more dollars to buy a Bitcoin, and then the price of Bitcoin's higher in dollar terms. And it's like that with other currencies too. But the other thing is the Federal Reserve can, I think, really impact crypto. So when there's a very, very over time close correlation to liquidity and asset prices. As liquidity is rising, what happens with that money? It finds its way into investments. So if you look at a global liquidity cycle, it's like a spitting image of the ups and downs and cycles of stocks or crypto. So right now the Fed is still somewhat restrictive, and they obviously wanted to quell inflation, and they've cut rates, but they're still at a restrictive level, even in their own words. If we were to see a drop in the economy, I've seen a lot of signs out there of potential recession. I'm seeing signs that the economy was slowing even before all this tariff stuff, which is only going to cause more demand destruction and slow things down. But Q1 GDP, which at the time of recording here is going to be released like tomorrow, that's something that could be negative. And that's certainly a warning sign for a potential recession. I'm seeing the labor market slow, seeing the consumer be completely strapped, maxed out on debt, buy now, pay later programs, crazy numbers on like 43% are delinquent on those, and they're using them for groceries. So you're taking out basically installment loans to go buy groceries or to bridge to the next paycheck. Not exactly the sign of a strong economy. And what's propping up the economy has been government spending and the top 10%. But we're trying to reduce government spending now. And the top 10%, there's something called the wealth effect, which means when your portfolio is looking good, you spend money because you feel wealthier. But there's also a negative wealth effect. And with the decline we've seen in stocks, that makes those people that were propping up the economy feel less wealthy. If you see the economy really go down the tubes and you see stocks come down, what's the Fed going to be pressured to do? The Fed is going to be pressured to cut rates. And if they do cut rates, that oftentimes does help stocks and help cryptocurrencies because you are creating more liquidity in the market, and that liquidity finds its way into assets. So I do think that that could help things as well. But it's going to be interesting. This is one of the most interesting markets that I've seen because there's so much uncertainty. There's so much headline risk with, hey, tariffs are on, tariffs are off to, or they're at the baseline of 10% for everybody but China. Are we having talks with China or not? What's the resolution going to be there? A lot of companies obviously, feeling it from increased import costs and such like that. And it's one of the most fluid and volatile times that I've seen. But I certainly think there's opportunity during those times, and I think that any drops you see in asset prices as it relates to these things, I wouldn't panic. I think the worst thing to do is to panic. There's a saying I like out there, and there's a couple versions of it. Baron Rothschild famously said, "You got to buy when there's blood in the streets." Others have said, you want to be a buyer on the most pessimistic day and a seller on the most optimistic day. Boy, we go back to the last Bitcoin cycle. I remember it was around like 64,000, and everybody was talking about Bitcoin to 100, 200K. There was all this euphoria. That was the best time to be a seller. And then Bitcoin came down in the bear market to like a little over 15,000, and everybody was talking about it going to zero. That was the best time to be a buyer. So I'm not necessarily saying that we're at one of those points in times now, but I think sometimes people hurt themselves the most, and it's self-inflicted by panicking and selling. I've heard some stories, just with the tariff announcements, where you saw stocks drop like $3,000 on like the Dow in a day. I mean, and the Nasdaq and the S&P. People panicked and sold only to see most of that reversed in the next few days. I mean, talk about a bad time to sell, right? So I think if we do see some volatility, we do see prices move lower, it's a great opportunity if you can, and you have the ability to buy some more, lower your cost basis potentially, and be opportunistic, especially if you're what I would hope most people listening are, which is more longer term investors, because it's difficult to be, everybody wants to get rich quick and stuff. And that's why some people buy some of these shit coins out there that, they're pumped up by different influencers. But the bottom line is as they're being pumped up and you're buying, they're selling and getting rich. And then the rug gets pulled out under you and you lose everything, right? So, if you have a longer term investment mindset, boy, I think it's the best investment class that's out there.
We're not going to talk about the Shiba Inu that I bought, Dan. It wasn't a lot of money.
That's one of those, like, kind of like Doge and stuff, right? Where a lot of these ones, they don't have utility, which means that they're not serving a purpose. It's like a meme coin is really what it's called. So I'll just give you quickly my kind of breakdown. I own a lot of coins, but my biggest by far, Bitcoin, roughly, I don't know, 70 to 75% of my portfolio, then Ethereum, and then XRP and Solana. And, they have real use cases. I mean, Ethereum's a network that many decentralized apps are being built on. Solana's one of the fastest networks out there, if not the fastest. XRP is used for global remittance payments, as Bank of America uses it. I've heard stories that they use it exclusively in their international transactions, but these are coins that are actually creating savings and efficiencies in the real world, and they have utility or use cases. I personally like to invest in coins like that, as opposed to, I mean, don't get me wrong, some people got very wealthy buying Dogecoin when it went up, but that's a risk that I don't think is very calculated, and I personally don't believe in.
Sure. That's like buying a lotto ticket.
Exactly.
Well, no, you answered one of my last questions here, which was, which are your favorites? I do have, I have Bitcoin and Ethereum, and then, I got onto that, Shiba Inu thing, but I've heard a lot about XRP, and it sounds like it is very utility and maybe, something that to keep an eye on.
Mm-hmm.
So I'll do that. I just got a couple wrap up questions here, Dan. I know we committed to wrapping this up on time. Just as a ballpark, if some people are not invested in this right now, whether they have a 401k and they want to move it into one of these ETFs, which you could certainly do with your investments, or whether or not you have money somewhere else. Do you have a ballpark that you usually tell people from a percentage of their investment portfolio to put towards crypto? I mean, you might be a little bit more bullish on it, but just curious if you have a ballpark number that you recommend.
So, Tony, before doing what I do at MBS Highway and CryptoCharged, I was a financial advisor at Morgan Stanley. And, one of the things that you always explain to your customers is that you want to have a diversified portfolio. And if you imagine like a pizza pie, you're going to have different slivers of that pie based on when you're going to need the money, your time horizon, and your risk tolerance. And one piece of that pie is going to be stocks or risk-on assets, and that could include crypto. One part may be bonds, emerging markets, precious metals. And it's a tough question to answer because it's different for everybody. If you are 80 years old and you're like retired and you're going to need this money, I probably wouldn't put you in risky assets because you do not have the time horizon to weather market fluctuations. If you're very young, the younger you are, the higher risk you should be taking, because we've only seen stocks over time go up, but that doesn't mean that there's not, painful periods of time. But if it's in a retirement account, number one, if you have a 401k with a company, you should try your best to max it out, or at least max out the match if they give you one. But then if you leave your company, those 401k plans are sponsored, which means that there's a select limited amount of options. A lot of them are not great. They're like target dated funds. There's inert fees that are kind of hidden that you don't know about. A lot of people leave their company and then they leave their 401k. It's probably the worst thing you could do. You should always roll that over into an IRA, and you could do either a Roth or a traditional. But when you do it into an IRA, you can then invest in anything you want, but in a tax advantaged account. And now they have retirement type accounts that you can invest in crypto too, which I think is great, because I think that especially over a long time horizon, even though they're risky, that's going to really do well for your retirement. So as far as a percent goes, it's hard to give an exact one because everybody's situation and risk tolerance is different. But I would say if I were to use like a rule of thumb, like if you really like it or believe in it, I don't know, 5%. If you don't, 2%. I think you should, even if you don't like it, I think you should have some exposure.
But don't put half your. But you wouldn't recommend someone putting half their money into
no,
crypto.
No.
Yeah.
No. I mean, it's just too risky, and you don't want to put dollars into an investment that's risky like that you might need in the short term. Yeah. So always want to think of doing things in a balanced, diversified way, and only take on the risk that you're willing to lose or deal with.
Yeah, great advice. And
wait, Tony, there's one more thing.
Okay,
just because of your audience. So this is going to be a little out of the box, probably, from what most people talk about when they talk about crypto. But I think crypto could influence home values, actually. And there's been a ton of wealth created in crypto already, right? So, a couple $1 trillion in wealth just, over the last, let's say, year. And if crypto does continue higher and hit some of these targets, just think about all the wealth that's going to create. And there's been some research done by companies like Pew Research where they say those with crypto gains are 2 times more likely to spend it than gains from any other assets. And I'm speculating here, but I think many are going to actually maybe take their digital gains and exchange them for something more tangible like real estate, especially when you look at the majority of people that own crypto. So all adults, a little less than like 1 in 5 own cryptocurrency. But where's the majority? The majority are people that are younger, aged 18 to 29. And by the way, that's like your Gen Z cohort. The home ownership rate's only 8%. So, if we see crypto go higher, these people sell it, then, I think there's a good chance that it actually could cause more housing demand in a counterintuitive type way, maybe, or in an out-of-the-box thinking kind of way. And that could actually help to drive housing demand and drive home prices a bit. And there's also been other research done where there's a correlation between areas in the country that have a higher concentration of people that own crypto and higher home values. And listen, if you want to learn more about crypto, I saw a need out there because so many people didn't understand it. It's not easy to understand. There's not great resources that I was able to find that really held your hand and took something as complex as this and made it easy to understand. So a lot of people I saw were pretty much just investing blind. They were seeing something on social or one of their friends. They don't even know what it is they're buying. I think you should always know what you're buying. And they were getting hurt and they were buying at the wrong times. They didn't have an understanding. They were buying coins that were scams. So I created a service called CryptoCharge, which is really, this isn't like financial advice, but it's an education platform that is meant to help you understand it and make better informed investment decisions. And every day we do video breakdowns. We have a coin library that kind of takes you through like all the coins out there, at least the bigger ones, and explains a lot about the coin, gives you technical analysis and entry and exit points, dollar cost averaging points and such. There's a site that you can go to called CryptoCharge.com. And if you want to try it free for 30 days, you want to get 50% off, just use code CMA. And you'll be able to try it for 30 days, and then you get 50% off. It's like $49 a month or $4.99 a year if you wanted to check it out. But you do get 30 days to see if you like it.
Well, that's perfect. Dan, I appreciate you sharing that because I wanted, I knew we would introduce some people maybe to the idea of investing in crypto. They want to learn more about it. And you're right. There's not a lot of great information, and it's hard to know who to trust. If you just try to go to YouTube and do whatever, you don't know what you're getting. I mean, Dan is a real trusted source. And so thank you for sharing that information with our audience, because if people do, look, it's not for everybody. I get it. But if you are interested, getting some guidance from, an expert and someone that I really trust, I think is worthwhile. I kind of hijacked you at the beginning because I think you were ready to do a market update on MBS. And I said, dude, I want to talk about crypto today. So I appreciate you making the pivot, because this is really what I wanted to share with my audience. And I think we covered a lot today. And even for me, I learned some new things that I didn't know. I'm sure with this crazy market, Dan, there'll be some point in the future where I'll beg you to come back on and give my, I do market updates often. A lot of my information comes from multiple sources, one of which is your guys' videos that I watch every single morning. But there's going to be some big changes, I think. Which way it's going to go, time will tell. But maybe at some point in the future, we can get back on, do a deeper dive into what's going on with the housing market. I kind of want to get through some of the tariff craziness. I want to get a couple quarters, maybe as we get into say the third or fourth quarter of the year, we can kind of see more clarity. I can see how this played out, and then go back and take a look and see what happened. I'm still bullish on rates coming down this year. I just saw the NBA revise their numbers that they actually think rates are not going to be lower as much as they had previously predicted.
I think we're going to get to the low sixes, Tony. That's my forecast.
Yeah, I think so too. And I think people are underestimating if energy prices continue to drop, the impact that's going to have. I'm really, I've talked about it multiple times on my podcast. I'm still pretty bullish on that. And we'll see how all this tariff stuff plays out. But nonetheless, Dan, I appreciate your time today. And again, the way that you break this all down, it was super helpful for our audience. Appreciate you taking the time. And I'll catch you on the next episode. For those of you watching, look, tell someone about this episode, please. If you got value out of this, let them know. Let them know what we're doing here at Market Shares. And remember, we drop a new episode every single Friday at 10 a.m. Pacific time. So make sure you tune into that. And until then, take care.